The double top reversal is a bearish reversal pattern typically found on bar charts, line charts, and candlestick charts. As its name implies, the pattern is made up of two consecutive peaks that are roughly equal, with a moderate trough in between. Note that a double top reversal on a bar or line chart is completely different from a double top breakout on a P and F chart. Namely, double top breakouts on P and F charts are bullish patterns that mark an upside resistance breakout. Although there can be variations, the classic double top reversal marks at least an intermediate term, if not long-term, change in trend from bullish to bearish. Many potential double top reversals can form along the way up, but until key support is broken, a reversal cannot be confirmed. For clarification, we will look at the key points in the formation and then walk through an example. Prior trend. With any reversal pattern, there must be an existing trend to reverse. In the case of the double top reversal, a significant uptrend of several months should be in place. First peak. The first peak should mark the highest point of the current trend. As such, the first peak is fairly normal and the uptrend is not in jeopardy, or in question, at this time. Trough. After the first peak, there is generally a decline of 10 to 20%. Volume on the decline from the first peak is usually inconsequential. The lows are sometimes rounded or drawn out a bit, which can be a sign of tepid demand. Second peak. The advance off the lows usually occurs with low volume and meets resistance from the previous high. Resistance from the previous high should be expected. Even after meeting resistance, only the possibility of a double top reversal exists. The pattern still needs to be confirmed. The time period between peaks can vary from a few weeks to many months, with the norm being 1 to 3 months. While exact peaks are preferable, there is some leeway. Usually, a peak within 3% of the previous high is adequate. Decline from peak. The subsequent decline from the second peak should witness an expansion in volume and/or an accelerated descent, perhaps marked with a gap or two. Such a decline shows that the forces of demand are weaker than supply and a support test is imminent. Support break. Even after trading down to support, the double top reversal and trend reversal are still not complete. Breaking support from the lowest point between the peaks completes the double top reversal. This too should occur with an increase in volume and/or an accelerated descent. Support turned resistance. Broken support becomes potential resistance, and there is sometimes a test of this newfound resistance level with a reaction rally. Such a test can offer a second chance to exit a position or initiate a short. Price target. The distance from support break to peak can be subtracted from the support break for a price target. This would infer that the bigger the formation is, the larger the potential decline. While the double top reversal formation may seem straightforward, technicians should take proper steps to avoid deceptive double top reversals. The peaks should be separated by about a month. If the peaks are too close, they could just represent normal resistance rather than a lasting change in the supply-demand picture. Ensure that the low between the peaks declines at least 10%. Declines less than 10% may not be indicative of a significant increase in selling pressure. After the decline, analyze the trough for clues on the strength of demand. If the trough drags on a bit and has trouble moving back up, demand could be drying up. When the security does advance, look for a contraction in volume as a further indication of weakening demand. Perhaps the most important aspect of a double top reversal is to avoid jumping the gun. Wait for support to be broken in a convincing manner, and usually with an expansion of volume. A price or time filter can be applied to differentiate between valid and false support breaks. A price filter might require a 3% support break before validation. A time filter might require the support break to hold for 3 days before considering it valid. The trend is in force until proven otherwise. This applies to the double top reversal as well. Until support is broken in a convincing manner, the trend remains up. The double bottom reversal is a bullish reversal pattern typically found on bar charts, line charts, and candlestick charts. As its name implies, the pattern is made up of two consecutive troughs that are roughly equal, with a moderate peak in between. Note that a double bottom reversal on a bar or line chart is completely different from double bottom breakdown on a P and F chart. Namely, double bottom breakdowns on P and F charts are bearish patterns that mark a downside support break. Although there can be variations, the classic double bottom reversal usually marks an intermediate or long-term change in trend. Many potential double bottom reversals can form during a downtrend, but until key resistance is broken, a reversal cannot be confirmed. To help clarify, we will look at the key points in the formation. Prior trend. With any reversal pattern, there must be an existing trend to reverse. In the case of the double bottom reversal, a significant downtrend of several months should be in place. First trough. The first trough should mark the lowest point of the current trend. As such, the first trough is fairly normal in appearance and the downtrend remains firmly in place. Peak. After the first trough, an advance takes place that typically ranges from 10 to 20%. Volume on the advance from the first trough is usually inconsequential, but an increase could signal early accumulation. The high of the peak is sometimes rounded or drawn out a bit from the hesitation to go back down. This hesitation indicates that demand is increasing, but still not strong enough for a breakout. Second trough. The decline off of the reaction high usually occurs with low volume and meets support from the previous low. Support from the previous low should be expected. Even after establishing support, only the possibility of a double bottom reversal exists, and it still needs to be confirmed. The time period between troughs can vary from a few weeks to many months, with the norm being 1 to 3 months. While exact troughs are preferable, there is some room to maneuver. Typically, a trough within 3% of its predecessor is considered valid. Advance from trough. Volume is more important for the double bottom reversal than the double top. There should be clear evidence that volume and buying pressure are accelerating during the advance off of the second trough. An accelerated ascent, perhaps marked with a gap or two, also indicates a potential change in sentiment. Resistance break. Even after trading up to resistance, the double top and trend reversal are still not complete. Breaking resistance from the highest point between the troughs completes the double bottom reversal. Like advances, these should occur with an increase in volume and/or an accelerated ascent. Resistance turns support. Broken resistance becomes potential support, and there is sometimes a test of this newfound support level with the first correction. Such a test can offer a second chance to close a short position or initiate a long. Price target. The distance from the resistance breakout to trough lows can be added on top of the resistance break to estimate a target. This would imply that the bigger the formation is, the larger the potential advance. It is important to remember that the double bottom reversal is an intermediate to long-term reversal pattern that will not form in a few days. Even though formation in a few weeks is possible, it is preferable to have at least 4 weeks between lows. Bottoms usually take longer to form than tops. Patience can often be a virtue. Give the pattern time to develop and look for the proper clues. The advance off of the first trough should be 10 to 20%. The second trough should form a low within 3% of the previous low, and volume on the ensuing advance should increase. Volume indicators such as check-in money flow, OBV, and accumulation distribution can be used to look for signs of buying pressure. Just as with the double top, it is paramount to wait for the resistance breakout. The formation is not complete until the previous reaction high is taken out.